So it's a really tough pill to swallow when a spouse passes and now they're having to figure out, how can I get more income? And so with that being said, sometimes those clients will come to us looking to fill that void. And that's where we can truly help them. And we can do it a number of ways. But in the scenario that I'm going to show you now, it's going to be kind of reverse engineering this income need. So rather than just considering a lump sum of money to put in and figuring out how much income you can get, we know exactly how much income has been lost, and we know how much needs to be, filled. How much do we need to fill that void and that gap to make that person whole again from a financial perspective? And so let's assume the surviving spouse is a female and she's, let's just say 70 years old, and her husband passed away, and she's now left with a situation of needing income to offset the loss of that Social Security. And so we know that she was getting $1,800 a month, and she's looking for this income to start immediately. She wants it to start right out of the gate. So what we'll do is we'll go to this deferral bar here, and we'll go ahead and drop it down to 0 years. And now what we're doing is reverse engineering what this premium amount would be, what premium amount would be required in order to generate that $1,800 a month on a guaranteed lifetime basis, so that this income will cover her for as long as she lives, as long as she has a pulse, and she can live with peace of mind knowing that she doesn't have to manage finances to get income. She doesn't have to trade stocks to get income. She doesn't need to buy bonds and hope that the coupon rates are high to get income. She can really have peace of mind and clarity that this income is going to pay her like a private pension, and it's going to pay her for the rest of her life. And so what the software is doing here is it's ranking the options based on the least amount of premium needed to get that amount of income. So we'll see Nationwide comes in number one at $262,774. The next option would be Fidelity and Guarantee Life. And the initial premium needed to secure that $1,800 a month guaranteed would be $265,031. And then last but not least, Corebridge, rounding out the top three at $266,667. And so, you'll notice all the other companies and how they stack up. It requires more premium to get the same amount of income. And our goal is to help, really help you meet your needs and do so with your best interest in mind. And that is, who can give you that income that you need and that you want to count on every month, no different than when your spouse was here. And who's going to do that for the least amount of premium investment? And that's how we would figure out that scenario, is by reverse engineering it, inputting the amount of money you want, and then equating how much premium would be needed to get it. Last but not least on that scenario, that also is another scenario in a similar fashion with people that come to us where they're trying to offset the loss of a pension. I can't tell you how many people come to us where they have a pension, either their spouse has a pension or they have a pension, but they only have single life on that pension, meaning if they die, that pension goes away. That's a huge blow when you factor in the pension being lost and the Social Security being lost in the event that spouse passes. But it works the same way. We can help offset the loss of Social Security. We can also help offset the loss of a pension. So either one of those scenarios, we're happy to help in any way we can.
If I can interject just on some information you had shared, don't share it yet, but what you were just showing in the results of the search options, and I may have been out of the meeting when you mentioned this, but we saw some options which had a bonus, some that didn't. We saw two scenarios that you've brought up so far in which one had a bonus and it was the top option. One had a bonus and it wasn't. So I think it really drives that point home in regard to using that marketing material as the driving force as to, this bonus is going to outperform this product versus another.
Yeah, that's a good observation. So I think I mentioned in the beginning of our call, and that is, don't get caught up around the hype of the roll up rate or the hype of the bonus. What matters most is the bottom line. Who's going to pay you the highest contractually guaranteed income? And however that number was derived, does it really matter?
Right.
We don't care. I don't care what the roll up rate was. I don't care what the bonus was or if it had a bonus. And I don't care what the payout rate was. What matters is what is the number? What is the bottom line? How it was derived, it doesn't matter. But you will see, and we'll cover it in the last segment here in a moment, how sometimes these annuities are misrepresented or misunderstood. And that's one of the ways.
Yeah, it's a great point. And through our proprietary process, we're also going to take a look at these companies and their ratings. We make that a factor in the determining what the right product is for our client base. And it's not always the highest income. So there are other factors we consider in making that decision and for somebody's needs.
Yeah, I mean, sometimes you'll see oftentimes the people that choose to work with us, they found annuities through someone they know or another advisor, or maybe they attended a workshop or a seminar. But sometimes they'll be, the product that they're pitched is a high income or a competitive income, but it's from a lesser rated company. And the question becomes is, does that matter to you? Do you care about who's essentially signing your paychecks every month and what their likelihood of being able to do that on an ongoing basis out into the future? And in most cases, the people we talk to, when they think about that, they do determine that that's important to them. And so when you look at financial ratings, in my opinion, we shouldn't be working with anything less than an A minus when we're talking about lifetime income. And we, even then, you need to really peel back the onion or unveil the curtain, because these companies can get an A minus rating, but it doesn't mean that they're entirely sound. They could be a very small company yet with an A minus rating. I like to have a minus or better, but with a big company, a big, from a size perspective, they have a large amount of money under management. And then they also have a very clean investment portfolio where they don't have any underperforming assets or non-performing assets. We want to make sure that they have a clean balance sheet, that they're really performing the way that they should, and that those investments that they're making are high quality. So we want to grade the quality of their investments and make sure that they're actually performing. We also want to look at their net incomes, their net revenues. Is this insurance company making money? And I can't tell you how many times we've done the research and found this company that is a popular name and they have a good rating and clients are being pitched this product. And then we pull up the balance sheet and they've been performing in the red for the last 3 years. Like, that's concerning to me. That's not somebody I would want to invest my money with. So that's how we treat it, is no different than if we were looking to do this on our own. One of the things that people can do out there, if you're looking for a way to do your own research, would be to go to the NAIC.org website, NAIC.org website. And here is where you can search. This is a consumer facing website. I'm going to go ahead and share my screen. I think this is a good segment.
Yeah, and we'll provide the link in the description here on the video too.
Yeah, so if you go to the NAIC website, you can type in any company name. So for an example, Nationwide was the one that came up number one on the last example. We can come down and find Nationwide Life and Annuity Company, click here, and then go to their financial overview. And this is going to show us exactly how Nationwide's financials are comprised. It'll even tell us their commencement date. So what year did they come into business for the annuity arm of their brand? It'll tell us their assets under management, their liabilities, and then the capital and surplus after factoring those two. In addition, it'll tell us their net incomes for the last 3 years. And here's a stat. Not saying Nationwide's bad, not saying that at all, but it is something to think about. In 2023, they were actually performing in the red with a negative $529 million. I mean, they lost $529 million.